The unimaginable delisting of Chinese companies from US exchanges has begun, which nobody would have imagined even a couple of years ago. In this video, we're going to talk about what this delisting is all about, how it all started, the possible reasons behind it, and my perspective about investing in them, along with the risks involved. Hi, my name is Sunny, and I make videos that affect a common man financially. If you're new to this channel, please subscribe to it alongside smashing that like button, as that will help me with the YouTube algorithm, which will be highly appreciated. Who would have imagined even a couple of years ago that Chinese stocks would start delisting from American stock exchanges? The news is everywhere, while some of them are sensationalizing it more than others. I sincerely believe that era of big Chinese companies heading to the US markets to raise money have halted, if not came to an end. It all started with the news when Chinese company Didi announced last week that it will immediately start the process of delisting from NYSE while starting their listing process on the Hong Kong Stock Exchange. The whole drama started in June when Chinese regulators banned Didi from app stores in China, saying they broke local data privacy laws along with posing cybersecurity risks. Thus, as expected, the share price collapsed. Upon their listing on NYSE, they raised a lot of money from US investors. Later, news came out that they had some issues with Chinese regulators. Let's see the effect of this on other major Chinese ADRs as compared to S&P index. As an example, for the last 6 months, S&P is up 10%, whereas NEO is down about 20%, Alibaba down 42, whereas DIDI is down almost 50%. Just think about it. Alibaba, a $300 billion company, is down 42% in 6 months. Imagine the amount of shareholder wealth destruction going on. It all started last year when Alibaba's founder Jack Ma publicly criticized Chinese banks along with regulators about not being flexible enough. Guess what? He was forced to abandon his record IPO just few days before listing, while subsequently all the crackdown on big tech companies started in China. Some of the experts are of the opinion China is all about control, where financial losses, if any, to these companies are not important at all. Remember, they don't have a free market economy like we do have in the West. Another reason being SEC's listing rules for foreign companies, where public company accounting oversight board should have the oversight over companies' audits just to make sure what they are saying is true. As money is being raised from US investors, thus to safeguard them from the events like Luckin Coffee stock where the books were forged. Therefore, if they don't fulfill audit requirements for 3 years, they will be forced to delist. On top of it all, Chinese regulators are not allowing this oversight, hence, it is a matter of time. If not sorted out, they will be delisted eventually. If you think from a rational point of view, a foreign company raising money from US investors, the least they have to do is to be honest with the financial data, thus, oversight should not be a problem. The main reason being it's our hard earned money invested, plus the integrity of the data they are putting out is a must. In my limited wisdom, I don't see anything wrong with SEC trying to safeguard our interests, but maybe because of the geopolitics between China and the US, it has reached this level. Let's talk about the facts. No foreign company can own 100% of a business in China, that's their law. Tesla was the first Western company to build up a plant which they own 100% without any local partners or technology transfer. Ford, GM, and everybody else all have local partners along with technology transfer. They have got a very different system up there as compared to ours, which is a free market economy. Personally, I don't see this delisting to go beyond Didi or to other Chinese companies like Alibaba, NEO, or Xpeng. They are trying to control these tech giants and, if possible, have them dual listed on Hong Kong Stock Exchange. Keep in mind, all these Chinese ADRs are listed using the VIE company structure. In simple terms, when you buy a Chinese stock ADR, you don't have any direct ownership stake in the company itself, Rather, you own a part of their Cayman Island entity which has a profit sharing agreement with the parent company in China. I know it's very complicated. As an example, when you own Tesla stock, you have the part ownership in Tesla, the company, and its profit, not any Cayman Island entity. So there is always a regulatory risk in Chinese stocks, which is the reason they have always lagged equivalent to their American counterparts. It is for the same reason why my exposure to NEO is not the same what I have in Tesla, which is my way of risk management. But that is me, I might be wrong. Do your own due diligence before investing based on your risk tolerance. As a disclaimer, I'm not a financial advisor. Please consult one before investing based on your personal situation. This is my take on the topic Chinese delisting coming. If you like the content that I make, please help me and my channel by liking, sharing, and subscribing to it. Thanks for watching and see you in the next one.